Hello and welcome back to the Note. Well, it's the end of a hectic week on Wall Street and world markets, but we're still no closer to answering the critical question everybody wants to know, which is when is the Fed going to raise interest rates? Now, obviously the big event for the week was the publication of employment data for the US on Friday morning. In response to that, you saw 10-year bond yields come down very slightly, the dollar weakened very slightly, both of which would imply that this was seen as a disappointment, that there's a slightly less chance of an early rate rise. You can't put too much on it though, because stocks had really quite a bad week. They've almost eliminated their gains for the year. And so obviously people aren't hanging very much on this, although one piece of good news for the week as far as stock markets are concerned is that the Chinese stock market's big fall has arrested itself, at least for now. However, when it comes to the decision on rates, I think the most important markets to look at are oil and the dollar. If you take a look at Brent crude, this is critical to the shale revolution. It's critical to the economics that have been driving investment in the US economy of late. You saw a recovery in the oil price for several months. That has almost totally been eliminated now. If you see oil drop much further, that really does have much the same effect as a rate rise. It helps to constrict economic activity. Similarly, on the dollar, a strong dollar means cheaper imports. It means a less competitive export sector. It has much the same effect, in other words, as a rate rise. Again, you saw some weakening of the dollar a few months ago. That has now almost been reversed. If you see these two trends continue much longer, that really could put pressure on the Fed not to raise rates. However, you can also need to look at emerging markets. If you take a look at Brazil, perhaps the most obvious example, obvious political concerns there, their stock market is now down almost to the levels it plumbed at the worst of the crisis in 2008. The Fed does not want to add pressure on its currency by raising rates, doesn't want to be responsible for triggering a true crisis there. That's true broadly across emerging market foreign exchange. Again, emerging market devaluations have a habit of turning into serious financial and economic crises. It's a factor for the Fed. But you still can't avoid the basic mathematics of the employment market here in the US. This is what the Fed is watching most closely. It's what will help decide whether it really does go through with a rate rise. Plainly, the bottom line would be that it seems impossible from the labour market alone to justify keeping interest rates at emergency low levels. That is logic which is plainly apparent both to everyone in the market and to all the governors of the Federal Reserve. For the week that comes, there is still quite a lot more economic data. The earnings season is largely over. I suspect we have another month of volatility, still in quite a tight range, as people very nervously wait to hear what happens in September. The guessing game is not over yet.